Good morning from Prague here at CTP with update on the first half of 2025, which has been so far a very good 6 months. We at CTP say change is opportunity, and we have seen many different changes over the past years, and that has been good for our clients and our business. Yeah, we see trends of deglobalization to continue, which triggers nearshoring in Europe for Europe, and then in Europe for Europe. It's often Central Europe where companies land. Those are companies from all over the world, but also Asian companies, which is now good for more than 20% of our new business. Most of the new business we continue to do for existing clients, long-term loyal partners who we have built facilities for over the past decades in different countries throughout the CEE, region of Central Europe. And we continue to do so. So we get still more than 70% of all the business we do from our existing clients. But it's very good to have new companies come in as well. Many Asian, in particular, Chinese companies who have found their ways to Europe in order for them to grow their business and supply their European clients. So that has been good in numbers. So we've seen 1 million square meter of new leases, which we've signed first half this year. 1 million square meter is 11% more than we did during the first half of 2024, 11% up. And we've also been able to sign those leases at higher square meter prices, around 5% more compared to prices of 2024. And looking forward, we continue to see strong leasing activity. It is often the case that we close more deals in the second half of a year. So we're positive about the rest of 2025. Clients are happy. Tenants are happy. Retention rates continue to be 85%. Collection rate, that means the money we collect from the tenants, close to 100%, 99.7% of all the rent we charge, we get paid from our tenants. So they are very strong, financially healthy companies who grow. City Park model, so our unique business park concept continues to grow and is very successful. Mostly grow with existing clients and the companies who have been here who continue to grow their business, and often, in some cases, started as low-cost manufacturing, turned into a full-scope facility with R&D in-house and logistics facilities. So it became real big. We break it down at CTP. We talk about operator. Operator is our portfolio of income producing. We are at 93% occupancy, same to what we were before. We've been historically around 95, 93 at 6.2 years of WALT. That's the current figure. We have a portfolio now of around 13.5 million square meter. 13.5 million square meter is good for 757 million euro of rental income per year. That's the 13.5 million square meter portfolio, which we have built mostly. I think 80% of that is constructed by ourselves, and we have then also acquired some portfolios here and there as part of an entry strategy in a new market or in order for us to grow our market share, which we continue to do. We have around 1,500 different tenants in all those buildings. So that's good. And these buildings are well maintained. They're all BREEAM certified, and we look after those properties as if they were ours, which is the case. So we continue to invest to make sure that parks and buildings remain in excellent condition. That means we continue to invest in infrastructure, access to our parks, in green areas, adding amenities and facilities to those parks to make sure that parks remain attractive and often, I must say, become more attractive over the years because you're adding more companies and facilities and amenities, and then these parks grow and then become a center of activity and business for local communities. Obviously, also we team up with schools and other stakeholders, which is good. So you provide education as well as workforce to those clients in parks. We add incubators, smaller units, which I think there's more opportunities to build these SBUs, small business units, in different markets, especially in Germany, but also in the Czech Republic and other markets. Often as a part of a business park, could also be standalone sites where we develop, 30,000 square meter of SBUs in one location. That's what we're looking into. And maybe that's also the jump to the developer, our second activity. That's the in-house construction company. We build a lot of stuff. We have on the way more than 2 million square meters of projects currently. Some of that will be complete this year. So far this year, first half, we've completed and handed over around 224,000 square meters of space to our clients, fully leased. And the other properties, most of the 2 million will be completed during the second half and handed over to the second half of 25. And some projects will go into 26. Interesting, I think important to mention is that almost 80% of those projects and developments are within existing business parks. So those are parks which we started, where we bought land, built infrastructure, and we continue to add buildings and build buildings in those parks. Why is that so important? Well, it confirms the success of a park. You already own that land, you have done your infrastructure, so it's very nice to continue add and grow those business parks to become full-size business parks. And that's what a park is about. You continue to add companies and different industries to diversify also. When this 2 million is fully let, it will do another 160 million euro of rental income. And we will be around 10% yield on cost as we typically do. The people at the construction teams do value engineering and procurement, of course, but also make sure that we build the right quality for the right price, which then helps us to get to a 10% yield on cost. Upon completion, we think these buildings will be 80-90% leased. We start and then we continue to build. And most of when we start, we have a pre-lease for part of the building or for all of the building. And we build a bit of speculative here to also have an opportunity for companies who need something soon. We have something on stock, as we say. But typically we then get to over 90% once buildings are complete. Czech Republic, our home market, and very strong. I must congratulate the team here in Czech Republic. They do a fantastic job. Jakub Koller is at the helm of CTP Czech. He's done a great job. And he's been with us for a couple of years now. He started as a leasing guy and turned into a proper country head here. So congratulations to Jakub and his team for the fantastic achievements so far we have seen in the Czech Republic. Multiple projects on the way throughout the Czech Republic, in particular in Brno. CTP's home market, you could say, where also we do things for Hitachi. We're doing some things for Gerrit, for Honeywell, for other long-term clients. And at the CT Park Brno, which is a flagship business park, where we also now have more engaged the city, but also the university and the high school, which is good. It's, I think, next level business park. It's also a little bit of a kitchen, maybe, Brno, where we develop and invent new property types and new things, which is nice to see that the Czech teams continue to do that. That's good. Poland is good, strong, good demand. Piotr Flugel and his team started obviously much later in Poland compared to Czech. Czech we've been since the launch of CTP in 2000. And Poland also only came a couple of years ago with an acquisition of 7R, a friendly local developer, which we knew. We bought most of their land bank with some projects they had on the way. And Piotr Flugel and his team turned it into a development machine, and they continue to do one after the other side. So they currently have more than 100 people in Poland, in Warsaw, with offices in Poznan, in Katowice, and in Gdansk as well. That's good. And the Germans getting there. Nice team. I continue to spend a lot of time with them. Two things we do, two business lines in Deutsche Industrie, which is the portfolio of properties we bought a couple of years ago. 1.6 million square meters with many, many, many tenants. That is a very different business to our normal new build stuff. And we do both at the moment. So we have a couple of sites which are magnificent, are really nice, beautiful opportunities which we've been able to buy because we felt that the market was good to buy in Germany in the past years, and that resulted in us buying a site in Mülheim, in Düsseldorf, but also in places like Aachen, Krefeld, etc., for our new developments. And we have been able to start. So we're under construction in multiple sites, more than 20 locations throughout Germany, where we actually are either constructing or about to start construction, which is a mix of SBUs, so small units, 1,000 square meters with a loading dock and a door, a showroom, a little bit of a workshop or warehouse in strategic locations, but also custom build and warehouses all together. We've done some announcements on Mülheim, and we'll continue to do other announcements. So it's good. And that is also our core business going forward. At the same time, we look after the Deutsche Industrie, which we bought for cheap at that time, but also we need to do refurbishments and rental growth, which we have been able to do and continue to do. And now also with the new government in place, you see a change going on in Germany, and that results immediately in more demand for both Deutsche Industrie as well as our new developments. So quite positive about Germany. Yeah, fantastic group of people based in Wuppertal. Most of them, not all of them, more than 100. And I continue to go there every second week. We see more opportunity in Germany. Also good to see that some of the tenants we have in Germany are also active in other countries in Central Europe. So there's also a good opportunity to work with them more, to build on those relationships and grow the business together. That's for me so far. Thanks for dialing in and for your attention. I'll hand over to Maarten and, of course, remain available for any questions you may have later on. Thank you.
Moving on to the financial highlights. The like-for-like rental growth came to 4.9% in H125, driven by indexation and strong rent reversion. Occupancy at the H1 remained stable at 93%. Our gross rental income increased by 14.4% year-on-year to 367 million euros. And we continue to reduce our service charge leakage, bringing the NRI to GRI ratio to 98.1%. Annualized rental income increased to 757 million euros, illustrating the strong cash flow generation of our portfolio. And we confirm our target to reach an annualized rental income of 1 billion euros by 2027. Company-specific adjusted EPRA earnings increased by 12.2% year-on-year to 199.3 million euros. And CTP's company-specific adjusted EPRA earnings per share amounted to 42 euro, an increase of 6.2%. The lower year-on-year increase in the earnings per share is driven by the increased number of shares as a result of the equity raise in H2 24. But thanks to our backloaded deliveries and net development income in the second half of the year, the group is on track to reach its EPS guidance for the year, and we expect to return to double-digit EPS growth from 26 onwards. Now looking at the valuation results. The valuation results in the first half of the year came to 598 million euros. Of this, 181 million euros was driven by the construction and leasing progress on our developments, while 374 million euros came from the revaluation of our standing portfolio and 43 million euros from our land bank. Our standing portfolio saw on average 11 bips yield compression, while the ERVs increased by 2.5%. The total gross asset value now stands at 17.1 billion euros, up 7.2% from full year 24 and 15.9% year-on-year. CTP's reversionary yields stand at conservative 7%. And we saw yield compression in the first half of the year, but we also expect both further yield compression and positive ERV growth in the CE region in the second half of 25. In most CE markets, inflation-adjusted real rents remain lower than 15 years ago, illustrating both the affordability of the region for our tenants as well as the midterm rental growth potential. This is also illustrated by the new leases that we signed in H125, where rents were 5% higher than the new leases we signed in H124. It is also supported by the undersupplied nature of the CE markets, with only half of the industrial and logistics space per capita compared to UK or other Western European markets. We also saw transaction markets reopening across Europe, as there is more clarity around funding cost. And especially on the private equity side, with funds coming to their maturity, we expect to see more churn. This will further support our valuations, but as well offer opportunities for us. Our EPRA net tangible asset per share increased from 18 euro and 8 cents at year-end 24 to 19 euros and 36 cents at the half year, representing an increase of 7.1% since the beginning of the year. Year-on-year, the increase was 13.5%. With this NTA growth and our dividend, we delivered a total accounting return for our shareholders of 70% in the last 12 months, highlighting our superior return profile, which is unique for the real estate sector. And now I hand over to Richard.
In the first half of 2025, we secured 1.7 billion euros of debt to fund our organic growth. We issued 1 billion euros of bonds directly after our full year 2024 results, seizing the market opportunity of very attractive pricing ahead of the tariff announcements and the subsequent market turmoil. In addition, we closed our inaugural Samurai loan of 30 billion yen, the equivalent of 185 million euros. Diversifying the sources of our funding is one of our main priorities. We transformed CTP from a purely euro senior secured financing structure in 2020 to a largely unsecured financing structure through bonds, private placements, and unsecured syndicated facilities, consistent with our stable investment grade rating. Adding the Japanese yen market to our funding mix further improves our position, as the Japanese yen market, which is the world's third largest, is competitive at different times than the euro market. Finally, we signed a new unsecured facility of 500 million euros in June, which we drew down in July. We continued to actively manage our funding costs and negotiated margin reductions on 159 million euros of loans. In total, we have renegotiated or repaid over 1.5 billion euros of our most expensive bank loans in recent months. This includes the prepayment of the 441 million euros of expensive unsecured debt in H1 of 2025. The 272 million euros of bonds which matured in June were repaid from our available cash, and our cash position stands at 800 million euros. When including our 1.3 billion euro RCF and the new unsecured loan drawn in July, our pro forma cash position stands at 2.6 billion euros, more than sufficient to meet our cash needs for the next 12 months. The average maturity of our debt stands at 5.1 years, with only 254 million euros of debt maturing in 2025. At the end of the second quarter, our average cost of debt came to 3.2%, slightly up compared to year-end 2024 due to the new funding. Our current marginal cost of funding is close to 3.5% for 5-year money. And thanks to our strong cash-generating portfolio, we have a healthy interest coverage ratio of over 2.4 times, while our normalized net debt to EBITDA remains stable at 9.2 times. We expect the ICR to have bottomed out, as we showed during our Capital Markets Day last year. Thanks to our market-leading development yield on cost of over 10%, each euro we invest in our pipeline increases our ICR and decreases our net debt to EBITDA. Our loan-to-value decreased to 44.9% from year-end 2024, mainly thanks to the positive revaluation of our standing portfolio. We remain confident in the outlook for CTP. Leasing is strong. We see nearshoring speeding up in many industries, with production in Europe for Europe continuing to drive demand. Our pipeline is highly profitable and our growth is tenant-led. Thanks to our industry-leading yield on cost of over 10%, we're able to deliver sustainable and profitable organic growth while maintaining our strong financial position. We confirm our EPS guidance of 86 to 88 cents for 2025, representing 8 to 10% growth compared to 2024. We expect to deliver 1.2 to 1.7 million square meters of developments this year, in line with our long-term growth targets. Thank you for your attention. We now welcome your questions.
Thank you. We'll now start today's Q&A session. If you would like to ask a question and you've joined the conference call, please press star followed by 1 on your telephone keypad. And to remove your question, it's star followed by 2. If you've joined us on the webcast, please use the questions box and below the video player and type out your question. Our first question today comes from Marios Pastou from Bernstein. Your line is now open. Please go ahead with your question.
Good morning. Thank you for taking my questions and for the presentation. Just 2 questions from my side. So firstly, on the ERV growth of 2.5%, feels like it's broadly running in line with last year's levels. So any comment you can make on which markets are driving this performance and whether you think that type of momentum could continue over the second half? And then secondly, you now split out the pre-let levels of the 2025 deliveries into both new locations and existing. I'd almost have expected this would be the other way around, with greater levels of pre-letting in the existing locations where you have better visibility. Is this typical of the trends you see? Thank you.
Hi, Marius. Thanks for your question. Regarding the ERV growth, indeed 2.5% in the first half of the year. So we need to see what it will do in the second half of the year. But it comes back to the new leases we are signing. And we show you also the new leases that we are signing in the presentation, split out by country. Because if you take into account the market share we have in the Central and Eastern European region, that's quite a good indication of where market rents are going. So if you look to the different regions, you see we Czech Republic, and that's no news, sees a bit lower ERV growth or market rental growth because we have been able to increase already a lot in the last years. But we have seen some rental growth in the other markets, like Poland. We see a bit of ERV growth coming too. Same in Romania, actually, for that matter, if you look to the new leases we signed there. So there is the different stages that the countries are in terms of a market rental growth. And will always differ a bit year on year, country by country, but on average, and that's also what we said, I think, when we gave guidance for this year, we expect to be ERV growth in line with inflation or inflation plus. Inflation in the countries in which we are active is still most countries ranging somewhere between 2% and 3%, and that you see reflected in here. We don't see it slow down. As basically the supply-demand balance remains very healthy. You saw the amount of leases we did, 11% more than we did in H1 of last year, and a good amount of head of term signed, which is the forward leading indicator for the leasing activity we will do in the second half of the year. So as long as leasing remains strong, we expect market rent growth to be in line with inflation or slightly ahead. In terms of the pre-let, and Raymond can also comment more on it, but it comes back to the risk. Ultimately, if we start a new location, we want to have more security in terms of pre-letting because it's a new location, it's unproven. So therefore, we typically require more pre-letting before we start. If we have an existing location, and that's in line with what Raymond has been doing for the last 25 years, we will start building the next building when the park is full, even whether we have a pre-let, yes or no, because we know the location, we know there is demand, we know the tenants. So there we are much more comfortable to lease during the construction. And that has been our business model all along. So you need to see it from a risk perspective. This is actually not different than it was in other years. The pre-let typically on the new locations is higher than it is on the existing locations, where we have much more that comfort, and we'll always start with the next building if the park is full.
Thank you very much for the comment.
Our next question today comes from John Vuong from Kempen. Your line's now open. Please proceed with your question.
Hi, good morning. Thanks for taking my questions. Could you provide a bit more color on the building blocks for the 4.9% like-for-like? And also looking at your guidance, I suppose it's at 4% for the full year. How would we compare this to the 4.9%, as it kind of implies a deceleration in H2?
Yeah. In terms of, thanks for the question, John. In terms of the like-for-like composition, it's around 2.5% of indexation, and the other 2.4, 2.5 is from reversionary capture. So we have 14.9% reversionary potential on the portfolio. So it's the part of that we're able to capture in the last 6 months. So we're running ahead of the guidance, and we will do everything that we can to make sure that we stay ahead of the guidance.
There is always, of course, a bit timing in which half year or in which quarter you capture the reversion. So in Q1, as you might remember, the like for like was a bit lower. So we'll see. Like Richard said, of course, we target to be higher, but the 4% was based on what we saw in terms of full year impact when we gave the guidance at the beginning of this year.
Okay, that's clear. Thank you. And then just on your geographical exposure, I suppose you cover quite a fair share of the land between the Black Sea and the North Sea. But there's also quite some countries in Europe that you're not active in. How do you look at entering new ones, and perhaps what are your criteria for entering new ones?
Look, we are as you know, John, we are very much focused on our returns. Return requirements are leading, and it comes back to the tenants. Do the tenants ask us to be active in certain countries? Because also, if you look historically, that has been one of the main drivers for us to expand into new markets. Tenant-led expansion. So tenants asking us, can you also do something for us in Romania? Or tenants asking us, can you do something for us in Poland? And to take the Poland example, we were not active there for a long time, as you know, because we could not make our returns. But as soon as we saw the opportunity with the higher interest rate environment where we are in to make those returns, we entered the market. And that's also how we look at other European markets. There are a few large markets in which we are not active in Europe. We are not active in the UK. We are not active in France. We are not active in Spain, in Italy. But tenant demand and returns, that are the two main indicators. And then, of course, some markets we would consider expensive, UK for that matter. If we look at capital values there, it's not likely we will go there. So all those factors are feeding in there. But maybe Raymond also wants to comment more on that.
Yeah, sure. Well, I agree with what you said, Martin. On top of that, you can also only do one thing at a time. And with that, I mean, we have entered some new markets in line with what we said before the IPO. We said we would do more in Western European markets. And then we did the acquisition of that portfolio in Germany. Since then, we have been able to buy more land sites. We built a team. So now it's very much a focus on getting permits so that we can actually start to develop on the land we have bought in Germany. And also get more rent out of that Deutsche Industrie portfolio. So I think also that's what you need to do. You need to also give the organization the opportunity to grow and take some time to get up to speed before you take the next step. I think that's one thing which I would add to what Martin said. And another thing which I would add is that we are constantly looking at opportunities of where shall we go? Shall we go to a new market? And if so, what for? So we constantly do active market research. So we are keeping our eyes and ears open to make sure that we don't miss out on any opportunity, but in line with what we can do financially, in line with what we can do operationally. But yes, I think, so we will, we don't stop with operating in 10 markets. That's not the plan. The plan is clearly to continue to develop a strong platform with a very strong business model and a proven concept of full service business parks with a variety of different property types and a unique system of managing the tenants and the parks as we do with all the amenities, etc., etc. So that model has proven to be very successful. We constantly improve and fine tune, but it's definitely a product which we think in other countries will also be successful. So ultimately, of course, you will continue to grow and extend footprint in different markets going forward. Definitely, yeah, that's absolutely the plan. So more later to come.
Okay, that's clear. All right, we'll see. Thank you.
Thank you. Our next question comes from the line of Vivian Mackey from Degroof Petercam. Your line is now open. Please go ahead with your question.
Yes, good morning. Thank you for the presentation. Two questions on my end. First one is on the deliveries. Seeing that you deliver with 100% pre-let, you're very confident about the letting, looking at the head of terms. And finally, I think that the pre-let is above last year's in comparison. So are you confident about delivering, I would say, at or above the upper end of the 80-90% pre-let guidance at this stage?
Yeah, thanks for the question. Look, I think we always target to do 80 to 90. If we can achieve more, we will always try for that. The first half was exceptional with 100%. Don't expect us to keep that going forward. In terms of the comfort for this year, Martin mentioned earlier the increasing number of HOTs that we're signing, which is basically when we've reached a commercial agreement with the tenant, but we're moving forward to sign the formal lease document, which normally takes a couple of months. We're seeing those increasing. So yeah, we remain confident, in delivering, the 1.2 to 1.7 million square meters. We'll see how that tenant demand continues, but we would expect to be, comfortably within that and delivering, comfortably within the 80 to 90% pre-let range. So that's, we're just continuing, as Martin said earlier, continuing the long-term pattern that we do, build buildings next to the ones that we already have, and mostly lease them to our existing tenants. So it's a business that can repeat organic and deliver organic growth on a very regular basis.
All right. And to that extent, is it other element that will refrain you from narrowing the delivery range? I would assume that you have much more visibility into H2, which would have linked, I would say, lead you to narrow the 1.2 to 1.7, which still remain quite large.
Yeah, look, I mean, I hope you can join us on our Capital Markets Day in Wuppertal and the Ruhrgebiet in late September, and I think we'll be looking to narrow the guidance then.
Thanks. And then one final, more technical question on the current income taxes. If I look at the share that is included in the EPRA earnings, is way down compared to last year. Could you maybe just give a bit more detail? I could not find it in the full report either.
Yeah, it is driven by some one-offs, which we can recover. But maybe it's better that we take it offline. I can send you some of the details, because it's indeed quite technical.
Yeah, that sounds good. Thanks.
Thank you. Our next question comes from Suraj Goyal from Green Street. Your line is now open. Please go ahead.
Good morning, all. Thanks for taking my question. We've been seeing the nearshoring trend for a while now, benefiting from Asian occupiers relocating to Europe, serve Europe. But the leasing rate of growth for the Asian occupiers looks to have slowed somewhat in the first half of 25. Is there perhaps a ceiling that you're approaching? Just want to hear your thoughts on that. And then if this recent deceleration continues going forward, how would that impact your ERV growth, if at all, as well as the like-for-like guidance?
Yeah, I wouldn't characterize it as a slowdown, particularly. There's always a little bit of volatility around any of the leasing numbers when you deconstruct them into ever smaller component parts. Asian tenants have been running around 20% of our new leasing for the last year and a half. They continue to be that. There will always be a bit of volatility on a quarter-to-quarter basis, but we don't see any reduction in demand, particularly from Asian tenants. I let Raymond talk to his recent visit to to Asia on that. But no, I wouldn't particularly over-interpret one quarter or one half into a long-term trend. The long-term trend for nearshoring is going to remain intact. It's very clear now that we are in a world with higher trade barriers, which will mean less global trade, more local production. And as Europe represents 25% of the world's GDP, manufacturers will need to produce their products in Europe to sell competitively in Europe. So we would be confident in that trend continuing for quite some time.
Yeah, Richard, I can add to that that we see more demand. Yeah, so also you can see we've done more deals first half this year compared to last year, 2024, over the same 6 months period. And with regards to the travel and the contacts with Asian companies, as you know, we have an Asian team, so we have a Chinese team, people who are in Europe as well as in China, in order to make sure that we are close to Chinese companies, help them. Support them in the decision making and guide them, and make sure that they get the proper support to set up the business in Europe for the European clients, and that's happening, and there's more to come, and we've only seen the beginning. I think it's going to be much bigger. That's what I feel. We have a number of projects under construction, as you know. And that also attracts against suppliers. It also works as a kind of confirmation, as a reference. So I think there's way more to come. Chinese, but also Taiwanese. We have been working for Taiwanese companies for a long time. And currently we have under construction multiple projects for Taiwanese semiconductor business related in Germany, in Aachen, in Brno, Czech Republic, where is the cluster of Taiwanese semiconductor related businesses. There is another cluster in Dresden, Germany, where we have been able to buy 2 land sites, where we're currently in a zoning and permitting process, and on a daily, weekly basis doing different proposals. And I'm meeting on a weekly basis Chinese potential clients. So, and that we expect a lot from that. And and then there's different sectors. Yeah, this is maybe if you talk about Asian companies setting up business in Europe, that's definitely happening. And then there's certain industries. I refer to Germany. Now, there you see clearly from the defense industry, there's demand from defense industry related companies who are looking for space. That's clearly happening. Also energy, also for Germany. The Mülheim project, we announced Aeon as one of the first tenants. We will soon announce another tenant for Mülheim. It's you could call it an energy park. Yeah, there's also the second tenant for that project is also related to the energy sector. So energy, defense, semiconductor, and then also data center supply, pharmacy is strong, pet food. Yeah, we have referred to that earlier. Is strong. E-commerce is still in Central Europe growing. So there's all kind of different industries which there is lots of opportunity out there. So not slow down. No, it's not. That's not the plan. The plan is to continue growing. It's also what we see from the market. So good demand.
Thanks, both. Very clear. It's helpful.
Our next question today comes from Frederic Renard from Kepler Cheuvreux. Your line's now open. Please proceed.
Hi, good morning. I just wanted to come back on ERV and what you show in the presentation. Can you give us a bit some detail on geography? And I mean by that, namely Hungary and Poland. I see, for instance, rent in Hungary going down 4%, while it is up almost 10% in Poland, where vacancy is actually quite high. So I'm quite surprised for Poland. Is it due to different corridors that you have delivered assets, which could explain that increase? So basically, the question is, can you give some comment specifically for Hungary and Poland? And then the second question would be on subsector. Can you give us a bit some detail on which subsector might be more active going to H2? Last year, if you remember, you had a lot of questions on the auto industry. Can you give a bit more granularity on what happened over the last year on this subsector? Thank you.
Let me start with the ERV, and then I think Raymond can continue on the subsectors. So if you look to Poland, indeed, we have seen rental growth coming through. And that's because if you look to Poland, yes, vacancy went up a bit in 24, as there were still a lot of deliveries coming online, which were basically started in the low interest rate environment. So you saw vacancy going up in 24. But also, if you look to the forecasts from the brokers, whether it's a CBRE, whether it's a JLL, etc., they expect to be back in 1-2 years at 5%. Why is that? Because Poland continues to be economically very strong. And also, if you look to the demand, if you look to the net absorption, Poland is a good market, and we do good leasing there. And that's also one of the reasons why we have seen the rental growth there. And of course, there is always a bit what Richard said earlier, the individual deal you are signing. But in general, we are quite constructive on the Polish market, both in terms of rent as well as demand. If you look for Hungary, Hungary is a bit different, especially around Budapest. You see some oversupply, driven by a local developer who has been quite active there. Regional Hungary is better, actually. But around Budapest, there is a bit of oversupply. That has put some pressure on the rents there, the new rents that we are signing. Because ultimately, if you look to the reversion, there is still reversion embedded in our Hungarian portfolio. That are sometimes the things that happen, and then you adjust your developments. So in Hungary, we will do less speculative at the moment. And that's always how we have been operating. There can be local pockets of oversupply in certain cities, certain regions. Then you slow down your speculative developments there, because there is no point in competing head on head with one of your competitors who builds a building next door. You need to be realistic in that, and we are for sure. And that's also why we value our model with the in-house construction team also so much, because we have the flexibility to speed up and to slow down where we want. But overall, for Hungary, as a market, I would expect indeed this year not a lot of rental growth. First, the bit oversupply needs to be absorbed by the market, but it's also it's not a huge amount, but it's temporary, distorting probably some of the leasing we have done in the first half of the year. And then I let Raymond comment on the subsectors.
Okay, thank you, Martin. Yeah, well, yeah, indeed, as you said, the markets like in Hungary or in Budapest, maybe there is some bit of oversupply. But I mean, long term, there is rental growth, right? Not as much maybe as we've seen over the past years, or not as much as you see in the Czech Republic. But if you look long term, if you look, 3 years, 2 years, 5 years, and compared to today, then there is a significant rental growth. I mean, construction costs are not coming down. Land cost not, etc., etc. So the trend is that long term there's rental growth, and if you build proper buildings in the right locations, you maintain them well, I think you will sooner or later see rental growth, a steady rental growth. But yeah, that's one with regard. Yeah, and then also you mentioned Poland. And Poland, it depends also a bit on the location, of course, because it's a big country, the largest country in Central Europe, and also work closely with, or rely on, whatever the German economy, which is still the 4th largest economy in the world, and we see signs of recovery. So I think, I'm not sure what exactly submarkets. What would you like me to refer to, Martin? What do you want me to?
I think the question was more on the difference between automotive, 3PLs, manufacturing.
Yeah.
Yeah, I mean, I can take the automotive part. So if you look, I mean, we've been deconstructing the portfolio, and you see that also in the presentation. Growth of the leasing in different subsectors versus the overall leasing across the whole portfolio. What you can see is that in the last 2 years, we did 16% of our new leasing was with automotive versus a whole portfolio of 21%. When we first started showing this, I think 3 quarters ago, that was 14% for automotive. So a slight tick up in the last a couple of quarters. As I think, we benefit from Central Europe being the best cost location for manufacturing. And I think, as Raymond said right at the very start of the video, we see change as opportunity, and the change and the dislocation in the automotive industry is driving more of that towards the lower cost manufacturing locations, and that in Europe is predominantly Central Europe. And then generally, otherwise, we see good, solid demand from multiple sectors, whether it's retail, whether it's the logistics companies, or whether it's manufacturers, either nearshoring it from Asia or also tenants maybe moving from higher cost locations in Europe into lower cost locations in Central Europe.
Yeah, true. And it's also maybe to add to that, when you talk about automotive, I think that also includes tire warehouses, which is aftermarket. There is still car ownership is still growing, obviously. So you need tire warehouses or warehouses where you store tires. That's one. Then we have automotive, which is car part, also aftermarket for repairs of cars. What do you have? You have in the Czech Republic, we used to be a lot of automotive in Germany, in Bavaria, with Audi, BMW, Mercedes, and so that part of the world. And one of our projects, I remember, in the Czech Republic, City Park Bor, was also a good location for those automotive companies to supply the manufacturing of cars in South Germany. In the meantime, I think that turned a little bit, and Bor is now for different clients, as I refer to, pet food. Well, it's huge in terms of pet food. There's online Royal Canin, which is German, I think, part of Rewe, they do online pet food into Germany out of Bor in the Czech Republic. So there is, and maybe automotive moved a little bit to the east, to Central Europe, obviously. And also you see and whatnot, Chinese car part producers who supply different car makers with car seats, for example. And car seats you need, no matter if it's an electric vehicle or hybrid or traditional vehicle. So no, I'm not so concerned about it. I think diversification we were always keen on that. So the other way around, if you look at pharmacy, if you look at, as I mentioned, semiconductor, if you look at those industries, there is good opportunities out there in the different sectors and industries. And
Great.
Many possibilities.
Our next question comes from the line of Eleanor Screw from Barclays. Your line is now open. Please go ahead.
Team, thank you for the presentation. There were rumors earlier in the year that you were intending to acquire a Romanian portfolio. Can you give us any update on that? And then from your presentation, it looks like there are about 100,000 square meters of standing portfolio acquisitions. Can you give us some more color on those and maybe how you're thinking about acquisitions more generally, given your comments that the market's improving? Thanks.
Yeah, regarding the portfolio in Romania, that comes back to what we also disclosed in the Q1. We are waiting for competition approval. We haven't gotten that. The competition authority goes over their own agenda and their own timeline. So we are waiting for that, and we'll update the market when we get it. If you look to the acquisitions we disclosed, it's actually just over 50,000 square meters we bought here in the Czech Republic, in Pardubice, which were 2 buildings where we saw a nice value uplift as we could come in and bring some tenants in there. So we saw a nice opportunity there. As you know, in general, if you look to our M&A strategy, we are quite opportunistic there. We don't need M&A to grow because we grow 10 to 15% through our developments. That's our key growth engine. But if there is interesting acquisition opportunities, we always look, see whether they can comply with our return requirements, see what is the strategic benefit. Can we get some land with it? Can we basically strengthen certain tenant relations? Can we strengthen our market position in a certain region? So it's always a mix of the financial and the strategic requirements that feeds into those considerations. But yeah, it really depends on the opportunities that are there. So that's also, if you look historically, the acquisitions in our portfolio are always a bit volatile. And the big acquisition was, of course, Deutsche Industrie REIT. But other than that, acquisitions are actually more focused on land. We buy each year a bit more than 200 million euro of land. Last year, it was even a bit more as we bought a big site in Düsseldorf. Because ultimately, that's of course where we create most of our value. And acquisitions from standing buildings are just bolt-ons in certain locations when they make strategic and financial sense.
Okay, thanks very much.
Our next question today comes from Rob Jones from BNP Paribas. Your line's now open. Please proceed.
Great, thank you, team. Raymond, I've got one on Germany, and then Martin or Richard, one on development pipeline. Raymond, you talked at the start around Germany, so getting there, spend time every couple of weeks there. I appreciate you spend time pretty much all the portfolio every couple of weeks, but and also appreciate we'll get obviously more colour on Germany at the upcoming CMD. But maybe you could give some comment on, you know, when you are in Germany, are there any specific parts of the German business or its operations that you're focusing your time on specifically when you're there? And then Martin or Richard, in terms of the pre-letting of the 25 deliveries, I think you said that was just over 50%. First part is, how does that compare to last year at this stage? And the second question is, remind me what that is in terms of square meters. Thank you.
Thank you for the question, Rob. With regards to Germany, and so I like to explain how that works in order to answer your question. So we have two businesses. I start with I call it easy part, which is the new development. Okay, that's what we always do in any other country. So we go out, buy land, and then we do a design and a project, and we go out, get permits, building permits, and then we start to build with a pre-lease or in combination with some speculative development. And that activity is now starting. So in numbers, that means that I think we can complete around 150,000 square meter next year, 150 of new build, brand new industrial warehouses, but also some SBUs, some smaller units, often combined. So you have a business park like Mülheim. Mülheim is one of the sites we bought from Vallourec. It's close to Düsseldorf. It's a fantastic location. We needed some time to do the demolition, cleaning up of the site, and preparing the site for new development. And that is happening while we speak. And we think we can start on site in Q1 of next year with construction. So most of that will be complete by end of next year. That's the site where we have some pre-leases signed. We have announced Aeon. We will soon announce another well-known German company. And that's one activity. At the same time, we are building in Jülich, for example. It's close to Aachen. It's a pre-lease for a Taiwanese chip manufacturer. So Aachen is close to Eindhoven. Is all part of the semiconductor kind of industry and business and ecosystem. And then there's multiple sites in Aachen itself. We are doing a project. We are doing something in Krefeld, and those are multiple projects. And that business, I hope, will grow beyond the 150,000 square meter of production of us building properties. More than 150,000 square meter per year. So the target is more towards between 200 and 300,000 square meter on a yearly basis. And a significant part of that will also be Düsseldorf. That's the other site we bought, which has a 800,000 square meter, more than 800,000 square meter land. So we think we can do more than 400,000 square meter of lettable area over the coming years. So that's our core business, new developments. And I spend time with the teams. We have micro teams, as we call them. That means we have a small team in different regions, and those teams are responsible for the entire project. So from the design, permitting, construction management, et cetera. So we break it up, let's say, in different regions where we have dedicated teams of people who focus on such a project. And then we have out of Wuppertal, we have a legal team, we have a procurement, et cetera, so that we have services to support those micro teams in the various regions of the country, of Germany. As I said, Germany, fourth largest economy in the world. Obviously, certain regions are stronger than other regions. We have a special focus on North Rhine-Westphalia, so Düsseldorf area, Düsseldorf, Cologne, that part of Germany. But also we have an office in Stuttgart. We have a site in Frankfurt, which we acquired. We're also active in the north, so Hanover, Bremen, that part, and a bit less in the eastern part of Germany. But we do have a team in Berlin as well. So multiple teams throughout the country to cover the country to prepare for new developments. And I think we have been able to buy at good prices, and I think there was a good time to buy. Maybe now it's changing a little bit. As we see the more demand, obviously, Anyway, that's the first business. Second is the portfolio of properties which we have acquired with the acquisition of Deutsche Industrie. That's around 100 different buildings throughout Germany. They are older buildings. Some need refurbishment. For some, we are looking for tenants. Others, we do redevelopment, means demolition and new build. Overall, you could say that when we acquired it, I think the average rent was 36 euro, 36, so 3 euro per square meter average per square meter per month. And we have seen a rental growth, so we're now close to 50, I think, on average. So that's also where the valuation come from. But that's a dedicated team of people, a different group of people than the group who do the new developments. But there are two different businesses. On top, we have our solar business, which is 10 megawatts by year end. For Germany, we are working on a data center project. We put a team together, so it's still relatively new. It's only 2 years from the start, so we're still in the startup phase, shaping the organization, introducing all kind of IT projects, different processes. And so I'm involved like as an interim managing director, if you like. And then we have a management team of 4 people. And so that's my role, and it's very similar to what I've done in the Czech Republic or Romania or Poland, where at the start phase I'm a bit more involved than later on. We at CTP we call it Group A and Group B countries. So Group A have their own MD, they're well established, and then the B groups, the startup, the growth. There initially I'm a bit more involved during the setup, which is. I could be 1, 2, 3 years or so, and then a bit more engaged, a bit more involved, and then till we hand over to the local teams once they are more established, I would say, and once the local teams are up to speed. And also, I think this is the way of coming to quick decisions. When it comes to acquisitions of land or doing designs and. Moving forward. So that's and also Richard already mentioned it. We have invited you guys to come over to our Capital Markets Day, which will happen in in Wuppertal. So there also we have an opportunity to see the Wuppertal site, which we bought. That is a combination of some existing buildings, which we will keep. They're listed. They're older industrial properties, which we are currently refurbishing. There's also mostly leased already. But also we are going to build some new buildings there. So it's going to be another business park with a variety of different companies and businesses. Quite interesting, I think. And that also event will give you the opportunity to see Mülheim, Düsseldorf. So also get a better feel for the pipeline. And at the same time also for the team. And we will also visit some of the Deutsche Industrie properties. So you can actually see how those buildings look like, and what we do with those buildings in order to create more income and more value. But very positive about the progress we're making. And there's a bit more detail maybe, but that's what I do. And look forward to showing you around. Yeah, sure, pleasure.
And then Rob, to answer your second question, the pre-let ratio last year was 51%. It's 53%. This year, and that would give you a range between 650 and 900,000 square meters.
Okay. Appreciate that. Thank you.
Our next question comes from Nadir Rahman from UBS. Your line's now open. Please proceed with your question.
Hi, good morning all. Thank you for the presentation. So my first question is on the delivery pipeline and the guidance for 1.2 to 1.7 million square meters by year end. So if I look at the 2023 and 24 figures, I think by this stage of the year versus the deliveries you'd completed for the full year in those years, you'd completed around 25 to 35% of your delivery pipeline, whereas this year I can see that you've completed, if we take the midpoint of your guidance to be 1.45 million square meters, you would have completed 15 or so %. So I was just wondering what the downside risk is to the guidance that you've given us for the 1.2 to 1.7 million square meters for year end. So that's my first question.
There is no downside risk, otherwise we wouldn't have reiterated the guidance which we just did. Look, we are very comfortable. If you look to the leasing we've done, we have done more leases. And leasing is key. Leasing and construction progress. We are on track. And we are very comfortable that we will get into that range of 1.2 to 1.7.
Okay, that's very clear. And the second question is on a comment just made by Raymond on the data centers. Is this a project that's just being looked at in Germany, or do you have any other details at this stage on the timelines for this or what this could imply?
Yeah, we have previously also mentioned that we're looking into data center opportunities. We have some people at CTP who are experienced in this industry, and we have also researched and we appointed advisors to help us there. With regards to Germany, yeah, when buying the one of the sites in Germany, it comes with 100 megawatt of power, with an opportunity to increase that to maybe 300 megawatt. So that's one of and that's experts believe a suitable site for data center development. So. And where do we stand is that we are currently in a feasibility study. I would call it like that, and that's one, and that is two other sites with similar characteristics. Also in Germany, where currently, we are. In order for us to understand opportunities better. So yeah, that's where we are. So I would call it a feasibility study. I think we'll probably know a bit more by the Capital Markets Day event in end of September, or maybe on the next call. But it's definitely a sector or industry where we, want to make sure that we understand the opportunity, and if so, going forward, be part of that. Yeah, in one way or the other. That's all I can say at the moment, I think.
Perfect. Thank you. Very clear.
Yeah.
Thank you.
Thank you. Our next question today comes from Wim Louis from KBC Securities. On the leasing demand from Chinese tenants, can you give some color on the industries they are in? or they more subcontractors versus OEM? And do you see a relation to the tariff discussions between US and China that could benefit CEE investments in certain countries?
Yeah, interesting question. Is also the question we ask ourselves: what are the targets? Where should we search? What industries? A conclusion, I think, for the moment is that it's all over the place. That means that all companies, Chinese companies who like to sell in Europe, are actually interested in being in Europe because of many reasons. And the reasons are, for instance, when we had the COVID pandemic, we could not get goods out of Asia to Europe. That was one. And then we had geopolitical issues, and the Suez Canal was closed, and decarbonization. I mean, it's not fashionable to travel with goods all over the world, and you would rather manufacture locally for the markets, for local markets. And then the tariffs came. So there's many reasons why Asian companies, or in this case, Chinese companies, come to Europe because they want to sell to European consumers. What industries? All over. Chinese furniture makers. They do not maybe necessarily manufacture furniture in Europe, but they would ship parts of furniture from Asia, from China to Europe to assemble here in Europe and to sell it in Europe online or in their showrooms or through their distribution channels. So that's furniture makers or furniture sellers. Can be any other e-commerce, Chinese e-commerce industry. Can be, we are doing a project in Hungary for a Chinese company who are, they manufacture machines, vehicles, I would call, for the mining industry, agriculture industry, and construction industry. So construction, think of bulldozers, what do you call, and lifts, for outside facade cleaning or facade mounting, these kind of things. So that's very diverse. But also we have obviously Chinese is like Lenovo. They manufacture computers, right? But you have that's in Hungary, by the way, in Budapest, where we have done a factory for them and we extended with a distribution center. Automotive, there is suppliers to BMW and to Volkswagen, for example. BMW, Volkswagen, they require these suppliers to be in Europe, close by their factories. And BMW, for instance, they are currently investing €3 billion in a new factory. BMW is building a new factory in Debrecen in East Hungary, along the Romanian border. Anyway, so that attracts also Chinese automotive. What else? We have a Chinese company who supply Tesla. So and Tesla have a factory in Berlin. And this Chinese company, they work for Tesla in China, but they also work for Tesla here in Europe, and they are renting a factory from us in East Slovakia, which we have recently completed. So I think there is all kind of Chinese companies looking for space in Germany, but also in Central Europe for all type of different activities. So what you try to do is to catch them through our BizDev team in China or in Europe, different business delegations. We team up with the different embassies, with the, what do you have? You have these chambers of commerce, you have different presentations. We do online events for Chinese companies who are interested in learning more about the European market, about the legislation, about everything, labor, property related, etc., etc. So, Again, we do most of the business for existing clients, but if you ask us about where does new business opportunity come from, well, from different sectors, but also from different parts of the world, and this would be one.
Thank you. With that, we have no further questions in the queue at this time, so I'll hand back over to the management team for some closing remarks.
Yeah, we'd like to thank everyone for their questions. Look forward to seeing lots of you at the Capital Markets Day in September, and wish you all a great day. Thank you.
Thank you all for joining. That does conclude today's call. You may now disconnect your line.